Hello, and welcome to this week's market analysis segment of Up in the Air. I'm Max Vido, and will be providing all the information on the recent trends in soybean meal futures and where prices may go from here.
And I'm Josh Gugel, and I will be focusing on the June future contract of natural gas and the fundamentals impacting the market.
Let's start off by taking a look at the soy meal prices from last week. May soybean meal contracts closed Friday at $321.3 per short ton after turning down all week. Multiple times since the start of 2015, prices have reached the support level between $318 and $320, prompting buying from traders who have held long positions below $300 from October of last year. The trend says sell, with the current price falling between both the 20-day and 100-day moving average. Most factors support this bearish market trend. Approximately 60% of soybeans have been harvested in Brazil, whereas the harvest has just started in areas of Argentina. Recent estimates show crop sizes slightly larger than before, which is a change from the slight downscaling that occurred in previous months. Weather conditions remain favorable for the end of the harvest in Brazil, with precipitation forecast close to average. Argentina is expecting more dry weather, but it has seen plenty of rainfall in the growing period, most beneficial to the crop. All indications show that the crop yield will fulfill the market expectations. The U.S. dollar remains strong when compared to the Brazilian real and trended up since the end of last week, which may have explained the falling soy meal prices Thursday and Friday. Countries will start to look almost exclusively to the Brazilian crop, which will be more affordable because of this weak real. Domestically, Gulf's soy meal basis has weakened over the past month. Basis is the difference between the cash price buyers pay for the crop and the futures market price. The weakening basis indicates more supply in the market and less demand, which could be a cause for concern for any traders holding a long position in the market. The USDA will be releasing the March 31st prospective plantings and quarterly stocks report. Traders of the May soybean contract will be looking closely at the soybean stocks, which will indicate the current U.S. supply. The market predicts the stocks falling within a range of 1.25 and 1.41 billion bushels, higher than 1 billion reported stocks last year at this time. If the report shows up at the high end of this range, it will be interesting to see if the overwhelming supply of soybeans help prices break the support at 318 that has been holding steady since the start of the year. Now on to Josh with the natural gas report.
Taking a look at the weekly average temperature anomalies, you can see the below normal temperatures for most of the country during the first week of March. As spring approached, areas west of the Mississippi, with the exception of Texas, saw a substantial warm-up. Los Angeles has already seen 6 days above 90 degrees this month, and just last Friday, Phoenix got up to a high of 98. The Northeast on average stayed below normal for all of March. This contrast between temperature anomalies across the country has caused some volatility in the price of natural gas future contract, as I will touch on more later. Looking forward, the Climate Prediction Center is forecasting a continuation of this trend into April. As you can see, the forecast is predicting below normal temperatures for the Northeast and Texas, while the West is predicted to see above normal temperatures. The below normal temperatures in the Northeast should create some late season heating demand, which is uncommon given the time of the year. On the supply side, the most recent weekly natural gas storage report released by the Energy Information Administration revealed the first injection of the year, which came as a bit of a surprise to the market. Despite the heating demand in the east, the west region and producing region made up for it to produce a net change of 12 billion cubic feet in storage, bringing the total storage up to 1.479 trillion cubic feet. This total is a 63.6% increase when compared to last season and is right around the 5-year average for the state. These supply numbers overall have had a bearish effect on the market and prevented natural gas prices from rising more than they should during cold shots. The June futures contract for natural gas opened at $2.78.2 at the beginning of March, and currently they are trading at $2.68.5. Overall, March has been one bumpy roller coaster. Prices peaked at $2.98.4 on March 18th and bottomed out at $2.66.3 just this past Friday. The current trend has been bearish, mainly due to the injection of storage revealed in the report last week, along with the record warmth out west. For the time being, this downward trend looks to continue, but prices are near their season low, so most would expect prices to rise eventually given the spikiness we've seen.
Thanks for joining us for the weekly update on soybean futures and natural gas futures. We hope you enjoyed our market analysis and have taken away some useful information.
It's been a bumpy ride so far. Stay tuned next week for an update you don't want to miss. For Up in the Air, I'm Josh Gugel.
And I'm Max Vido.